Welcome to today's video, where we'll be exploring the topic of capital losses and their tax deductions. Investments can sometimes decrease in value, resulting in what is known as a capital loss. But fear not, as the U.S. tax system offers ways to mitigate these losses. In this video, we will focus on understanding short-term capital losses and their implications with carryovers. Before we dive deeper, here's the agenda for today. We'll start with understanding short-term capital losses, then move on to carryover of losses. We'll look at a practical example of handling capital losses, discuss the wash sale rule, and examine how capital gains and losses are netted. Lastly, we'll discuss the importance of consulting tax professionals for personalized advice. Let's begin by understanding short-term capital losses. These occur when you sell an asset which you've held for a year or less for a price lower than your purchase price. The loss is essentially the difference between the selling price and your adjusted basis, which includes the purchase price plus any commissions or fees. If your short-term capital losses exceed your short-term capital gains in a given tax year, you can deduct a maximum of $3,000 of net capital losses against your ordinary income. This means that the loss can help reduce your overall taxable income, potentially resulting in a lower tax bill. Additionally, any losses that surpass this $3,000 limit can be carried forward into future tax years. It's important to keep in mind that these carried forward losses retain their short-term designation. Let's delve into an example to illustrate how capital losses are handled. Imagine that in 2023, you incurred a $14,600 short-term capital loss. Moving into 2024, you managed a $1,900 short-term capital gain. The first step would be to net these against each other, resulting in a net short-term capital loss of $12,700 for 2024. You can deduct $3,000 of this against your ordinary income. This leaves a balance of $9,700, which can be carried forward to offset future capital gains or ordinary income up to the $3,000 yearly limit. It's time for a quick quiz. What is the maximum deductible amount of net capital losses against ordinary income in a tax year? Is it $1,000, $3,000, $5,000, or $10,000? You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is $3,000. The U.S. tax system permits you to deduct up to this amount annually against ordinary income for net capital losses. Now let's discuss the wash sale rule. This rule is crucial as it disallows the deduction of a loss if you repurchase the same or a substantially identical security within 30 days before or after the sale that generated the loss. Should a wash sale occur, the loss is added to the cost basis of the new security. Each year, capital gains and losses are netted. Short-term gains and losses are netted against each other, and separately, long-term gains and losses are netted against each other. The final net result is used to calculate the overall capital gain or loss for tax purposes, determining whether you deduct $3,000 or carry forward a portion or all of the loss. Navigating tax laws can be complex, so it's advisable to consult a qualified tax professional for personalized advice tailored to your specific financial situation. They will guide you through the intricacies of capital gains and losses, ensuring you maximize your deductions and comply with all relevant regulations, including the wash sale rule. To summarize, capital losses don't have to be as painful as they seem. They can be mitigated through tax deductions, allowing short-term losses to be deducted up to $3,000. Any excess can be carried forward. Be cautious of the wash sale rule, as it impacts deduction eligibility. For effective strategies and compliance, consulting with professionals is highly recommended. Thank you so much for watching this video. If you found it informative and helpful, please give it a like, share it with others, and subscribe to our channel for more great content. We'd love to hear your thoughts and feedback in the comments below.